If you are home shopping and you are only looking at the interest rate, you are about to make a very expensive mistake because your mortgage payment is not just the mortgage, it's a full monthly stack. And that stack is what determines whether you feel comfortable or house poor. Today I'm breaking down mortgages in plain English so you can buy smart and protect your cash flow. Hi everyone, I'm Neelam, Seattle Eastside area real estate advisor. On this channel, we talk real estate, financing, and the real world money trap buyers sellers run into. You don't learn the hard way. Let's get into the part nobody explains clearly. The only acronym you need, PITI, P-I-T-I. Your full monthly payment is built on PITI. Principal, that's the amount you actually owe on the loan. If you buy at X dollar and put down Y dollar, the rest is your loan balance. Interest, that's the fee you pay to borrow money. And yes, rate matters. But it's only one piece of your payment. Taxes. Property taxes are real money and they vary by location. Most lenders collect taxes monthly into an escrow account, then pay the county when due. Insurance. Homeowner's insurance protects the property. This also usually gets escrowed into your monthly payment. And I will add two more that hit buyers hard. HOA dues for condos, townhomes, newer communities. Utilities. Power, water, sewer, garbage, gas, internet. So when someone says my payment is $3,800, your next question should be, is that PITI only or all in with HOA and utility? PMI, what it is and what it is not. If you put less than 20% down on many conventional loans, you may pay PMI. Here's what PMI really is. It protects the lender, not you. Here's what PMI is not. It is not building equity. It is not making your house better. It's simply the cost of putting less money down. Now, PMI is not automatically bad. Sometimes PMI is the move if you need to buy sooner. You are in a market where waiting costs more. Your cash is better used as reserves, but you need to price it in objectively. Down payment myths buyers need to drop. Let's kill two myths. Number one, you need 20% down to buy. No, there are options. Conventional low down, FHA, VA if eligible, and others. Secondly, bigger down payment always wins. Not always. Bigger down payments do lower the payments and interest long term, yes, but it can also wipe out your cash reserves. I would rather not buy a home with a payment you can live with and still have money in the bank. 30-year versus 15-year, the real trade-off. Here's the simplest way to think about this. A 30-year usually gives you more breathing room monthly. A 15-year saves interest and builds equity faster, but your monthly payment can jump hard. I'm not here to shame on any loan choices. I'm here to make sure your choice matches your life. Because a financially perfect loan that makes you stressed every month is not perfect. The affordability rule I want buyers using. Most buyers get in trouble because they stop based on what the lender approves. I want you to shop based on what your life can comfortably support. A practical rule of thumb, try to keep your all-in housing cost around 30% of your net monthly income. And when I say all in, I mean PITI, HOA, utilities. Because life still happens. Childcare, car payments, groceries, travel, repair, medical stuff, saving and investing. If housing eats your whole paycheck, the house owns you. You don't own the house. The buyer math checklist. Simple, powerful. Before you fall in love with the house, run this math. What is the monthly payment? That's PITI. Add HOA if applicable. Add realistic utilities. Do you still have money left for life and savings? Do you have reserves after closing? Not just can I scrape the down payment? And one more. What happens if costs rise? Remember, taxes, insurance, HOAs do increase. It's real homeowner math. Buyer mistakes I see constantly. Quick list of common mistakes. Shopping by home price instead of monthly payment. Forgetting taxes and insurance. Underestimating HOA impact. Training all cash to win the house. Ignoring maintenance cost on older homes. Not planning for rate changes if using an ARM. Treating pre-approval like a spending limit. Don't do that. Buy with control. If you are buying a home, your superpower is not guessing. It's understanding the payment and protecting your cash flow. If you want, I can make a follow-up video where I break down how to estimate property taxes and insurance, how to evaluate HOAs, and how to compare loan options like a pro. If you're buying in the Seattle Eastside area and want a strategy built around your numbers, links are in the description. Drop a comment. What's your biggest mortgage question? Down payment, PMI, rates, or affordability? I'd be happy to help you.